Welcome to the Transparent FX Academy. If you're new to the channel, I'm Nick and I've been a top author on TradingView for many years, as well as being one of the only traders with a fully verified MyFX book track record. So if you want to elevate your trading, you're definitely in the right place. So subscribe to the channel, and without further ado, let's jump right into it. So take a second, pause the video, read the disclaimer, and I will see you on the charts. In this video, I'll speak about gold. First, I'll give you the technical aspect, then I'll move to the commitment of traders analysis to see what institutions in the market are doing and how they are moving and shifting their orders. And then I'll put together these two different types of analysis. So this is definitely a video you do not want to miss. Now, starting here from the monthly time frame, what we can see is that we have a market which at the moment is in a very strong uptrend. The market has been creating a series of impulses and corrections, developing a strong uptrend which is fueled by strong institutional buying. And we will be speaking about institutional buying in just a few moments when we move to the commitment of traders analysis. But for now, let's keep in mind that we are in a strong uptrend, that all this uptrend is coming as a development away from the break and retest from a very important historical structured zone, which is this one right here, which was acting as previous resistance for many years, every time holding the market below this level. And then after a break above the zone, what you would expect in any natural market conditions is to see the retest of that previous resistance turn support and a rejection to the upside, which is exactly what we got. We got the break, retest, rejection to the upside, and development of this huge monthly uptrend. Now, the last thing that we have to keep in mind here on the monthly time frame is that no market can just go up in a straight line. Every uptrend is composed by a series of impulses and corrections. Now, in this case, the last move was an impulse. So the next logical step would be for this market to provide a nice correction. Before then, yes, potentially continue higher, but at least in the short term, it seems like the market is in need of a deeper correction. Dropping down on the weekly time frame, the pattern that we have here is very clear. We can notice that we have a market which had created in ascending triangle formation. Now, this kind of pattern is developed in a situation in which buyers are in control, but sellers are trying to protect a strong resistance zone, which is exactly what was happening here. We had this resistance level, which was being protected by sellers every time the market wasn't managing to create new higher highs. However, at the exact same time, higher lows were continued to be printed along the way. So if you're seeing equal highs but higher lows, that is in ascending triangle formation, and at some point you expect the buyers to continue the uptrend, so essentially manage to create a breakout above the high, because if sellers would have been in control, then they would manage to create lower lows. But if lower lows are not happening and equal highs are happening, what you expect at some point is a breakout to the upside, which is exactly what happened here. We had a major breakout to the upside with a huge impulse to the upside. Now, as for what we have just said on the monthly time frame, also here, no market can just continue to go up in a straight line. After every impulse, the market will need a correction. And that is exactly what the market is already showing us. A nice correction here, which has already started from a weekly standpoint. Now, corrections give the possibility for new buyers to enter the market. So there is a possibility that now that the market is correcting, new buyers will enter the market, trying to bring price higher, especially institutional buyers. Just a quick interruption. Let me know in the comments below any new pairs or topics that you would like me to cover in my next videos, because I'm always open to suggestions. Let's drop down on the daily time frame and see what we have. Now, here on the daily, I spoke about gold just a few days ago when the market was around this level, and explained all the reasons for which I was expecting this rejection to the downside, which is in fact exactly what the market did. And by the way, I will link in description that previous analysis so you can go and check it out for more free education. But at the moment, what do we have? Well, before we dig deeper into what we have here from a technical perspective, first, let's go and see what we have when it comes to the commitment of traders, so what the big players in the market are doing. Now, the first thing to keep in mind is that if we're looking at the data for gold, we are already looking at gold against the USD, because all commodities on the spot are traded against the USD. And what we can see here is that net positions with the last reports have been increased quite a bit. We went from 214k net positions all the way up to 266k net positions. But even in the long term, if we look at what was happening in the long term, so the big picture, we were seeing a huge increase in net positions, going from 161k with 238k longs and 76k shorts, all the way up to now having 332k longs and only 66k shorts, with again 266k net positions. So institutions are currently holding a huge amount of longs compared to shorts. Now, obviously, there is the US government shutdown, so we don't really have the very last reports because the government is still in shutdown. But as soon as we will have the new reports, I wouldn't even be surprised to see essentially some shorts added in the short term with the last report, but in the long term, I will not be surprised to continue to see a huge amount of longs compared to shorts. Now, what this means, if we move here back to the chart, is that we have a situation in which corrections could definitely be used on the institutional side of the market to add more longs. And by the way, if you still haven't, make sure that you join my free Telegram channel, which you find linked in the description, so you never miss new updates. Now, back to the analysis. So in a situation like this, here in the daily, we have the creation of this M pattern. Now, after the creation of an M pattern, what you would expect is a rejection to the upside and completion of the pattern at the neckline. Why is this pattern so effective? Well, I'm sure you have seen this pattern already play out in the past, and it is quite an effective pattern. When you see an M pattern, like for example, right here, we were seeing this M pattern here. What you expect after that is the completion of the pattern at the neckline. We see another one here. We have the M pattern, the market then goes and completes at the neckline. Now, why is that? What is the psychology behind this pattern? When you see an M pattern, this means that essentially a lot of traders were trapped in the long, because when they see the impulse, the correction, and then the start of the continuation to the upside, what they will do is they will start adding longs. Their stop losses will be below the low, because that is how usually retail traders will place their stop loss. So if the market then drops and takes out of all those stop losses, that creates a lot of sell side liquidity, which institutions can use to actually buy. They can use that sell liquidity to buy. And at that point, after the M pattern is created and all retail traders have been liquidated, only at that point the M pattern completes at the neckline. Now, in this case, we don't only have an M pattern, but we also have a test of previous daily resistance, which is now turned support. This area, which was acting as previous daily resistance, is now turned support here. So there is an increased probability of seeing institutional buying inside of this level. So in a situation like this, what would I expect? Well, as usual, and as my students know very well, trading is reactive and not predictive. The monthly, weekly, and daily timeframes combined with the COT data, those are the best timeframes when it comes to the directional side of the market. But when it comes to identifying early shifts in the trend of a market, the best timeframes for that are the intraday timeframes, so 4 hour and lower. Therefore, I wouldn't be surprised if this market would shift from an intraday bearish to a bullish market and provide a potential rejection to the upside away from this level. That definitely wouldn't surprise me. Now, everything that you see me share here on YouTube is just the tip of the iceberg. In fact, if you want to learn more, I really suggest that you head over to my website, which you find linked in the description. Here, you have the possibility to gain access to the best mentorship program in the world. You can get all my courses ranging from the very basics of charting all the way to the more advanced topics. You also have the possibility to gain access to the trading station software with the Telegram notification integrations, one-on-one private mentoring directly with me, the COT data software, which is the software that you often see me use in my analysis, and you also have the possibility to gain access to the entertaining live trading show. So essentially a live stream of all my trades as they're happening live every day. So my entries, exits, how I manage the positions, all streamed live every single day. essentially in this Telegram channel, which is obviously private just for members. You also have the possibility to gain access to all my EAs. So essentially all my strategies, which you can then customize to your own preference. And here you see breakdowns of each and every one of my strategies, including a 10-year historical backtest of the strategy on high quality tick data. So essentially backtested on live charts. So basically, I would suggest that you go and check these ones out. And if you continue to scroll down past the testimonials, you will see that you have the possibility to join and gain automatically access with the email and password that you will create during the checkout process. So I really suggest to at least go and check it out. The link is in the description and I will see you in it. If you enjoyed the video, make sure that you drop a like and a comment. It really helps with the creation of new free analysis and education. And I will see you in my next video.